The Federal Reserve has just announced a massive bailout of nearly $300 billion for banks struggling with a liquidity crunch. This move comes in response to concerns about a potential financial crisis and aims to provide much-needed relief to the affected institutions. The Fed will offer short-term loans to eligible banks to help them meet their financial obligations and maintain adequate liquidity. This injection of funds is intended to prevent widespread panic and ensure the banking system remains stable. The decision to offer this bailout was not taken lightly, and it reflects the seriousness of the situation. Without this support, many banks could have faced insolvency, severely affecting the wider economy. While this bailout may be controversial, it is important to remember that the Fed's primary mandate is to maintain financial stability and promote economic growth. This move is just one out of the many tools at their disposal to achieve these objectives. And today, let's talk about what financial experts think about this new announcement from the Federal Reserve, which is a game changer for all the banks and investors in the US. Hey friends, welcome to Capitalista. Before we dive in, please take a moment to hit the like and subscribe buttons down below. Peter Schiff, a well-known economist, has boldly predicted inflation. He believes it is headed much higher due to the actions of the Federal Reserves, or the Fed. Schiff points to the Fed's recent decision to reduce its quantitative tightening program. This program involved the Fed selling off bonds it had purchased during the quantitative easing program, which was designed to stimulate the economy during the financial crisis. According to Schiff, the Fed had reduced its balance sheet by almost 4 months worth of quantitative tightening in just 1 week. This sudden shift, he argues, will lead to inflationary pressures that will be difficult for the Fed to control. Schiff's argument is based on the idea that the more money there is in circulation, the less valuable it becomes. This is because the supply of money is increasing faster than the supply of goods and services, leading to higher prices. While some economists disagree with Schiff's prediction, he has a track record of making accurate calls on economic trends. And as inflation continues to concern many people, Schiff's perspective is worth considering. Meanwhile, Jim Rickards, a renowned financial commentator, claimed that the Federal Reserve allocated $143 billion to holding companies of failed banks, including Signature Bank and the Silicon Valley Bank. According to Rickards, the Fed's move was an attempt to prevent a collapse in the banking system during the 2008 financial crisis. He believes that the government's decision to bail out the banks came at taxpayers' expense. Rickards argues that the Fed's actions created a moral hazard, encouraging banks to take excessive risks in the future, knowing they would be bailed out in a crisis. Jim Rickards recently made an interesting observation about Silicon Valley Bank's investment strategy. Apparently, the bank had parked most of their bonds in an HTM, or held to maturity account. This means they don't have to mark to market, which is a way of valuing assets based on current market prices. However, Jim warned that this strategy is risky if depositors started fleeing the bank. If too many people withdraw their money, the bank could be left with many illiquid assets that are hard to sell. To make matters worse, Silicon Valley Bank's loan agreement stated that borrowers had to keep their deposits with the bank. This locked the depositors into the bank, which could make it even harder for the bank to weather a sudden outflow of funds. Jim knew something was up when he heard rumors about deposits fleeing from Silicon Valley Bank. It wasn't long before he confirmed the news. People were withdrawing their money from the bank. This happened before the bank received a bailout, which was supposed to help them weather the storm. Customers were worried about the bank's financial stability and didn't want to risk losing their savings. And as more and more people pulled their money out, the bank situation became increasingly dire. But the good news is, the US government said that all Silicon Valley Bank customers can access their funds, even those above the FDIC insurance limit of $250,000. In a joint statement, the Treasury Department, Federal Reserve, and FDIC said that this move ensures the banking system protects deposits and provides credit access to households and businesses, promoting sustainable economic growth. About 85% of the $175 billion held at the bank was uninsured. The Federal Reserve also creates a new lending facility to prevent other small and regional banks from collapsing. Taxpayers won't pay for losses, and SVB senior management will be removed. Signature Bank of New York's depositors will also receive similar protection. Now, Jim Rickards claimed that after the 2008 financial crisis, the G20 finance ministers shifted their approach from bailouts to bail-ins. This meant that taxpayers would no longer be responsible for rescuing struggling banks. Instead, depositors would be the ones to suffer losses if a bank were to fail. In other words, depositors would have to take responsibility for their risks when depositing their money in a bank. This policy change aims aimed to prevent a repeat of the 2008 crisis where taxpayers had to bear the brunt of bank failures. While this approach may seem harsh, it encourages banks to be more responsible with their lending and investment decisions. Furthermore, during the 2020 pandemic, several billionaires including Mark Cuban, Bill Ackman, and Kevin O'Leary spoke out in favor of a bailout for struggling companies. They argued that the bailout was necessary to prevent an economic collapse and that it was the government's responsibility to provide assistance. Mark Cuban, the owner of the Dallas Mavericks, called for a trickle-up bailout, which would focus on providing assistance directly to consumers rather than to large corporations. Bill Ackman, a hedge fund manager, went on CNBC and gave an emotional plea for the government to take action to stop the spread of the virus. He warned that the country was facing a black swan event that could cause significant damage to the economy and that urgent action was needed. Kevin O'Leary, a Canadian businessman and television personality, also called for a bailout, arguing that it was necessary to prevent a wave of bankruptcies that would devastate the economy. He argued that the government needed to act quickly and decisively to support struggling businesses and that failure could have catastrophic consequences. These billionaires believed that a bailout was necessary to prevent an economic collapse and that it was the government's responsibility to provide assistance. They argued that the bailout should focus on helping directly to consumers and small businesses to help prevent a wave of bankruptcies that would devastate the economy. So, do you agree with what experts think on the issue? Let us know your thoughts on this in the comment section down below. And that's it for this video. Make sure to show your appreciation by giving a thumbs up, subscribing to the channel, and turning on notifications. This way you'll always be in the loop and never miss out on any of our uploads. Until next time, and take care.